Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. Tomorrow is the Good Friday holiday. Hence today is the last trading day of the month and quarter. All three major US indices are on track to their fifth straight positive month and second straight winning quarter. Speaking of quarter end, we also released our quarter 2 outlook today, and there are a few notable changes I'm sure you'll be keen to know. To do that, I have with me Manpreet Gill, our Chief Investment Officer for Africa, Middle East, and Europe. Welcome, Manpreet. At the start of the year, we shared in our 2024 outlook that it pointed there is a high likelihood of US experiencing a soft landing-like environment in the first half of 2024. How is that playing out so far?
Hi, John. Thanks for having me on. That's indeed correct. So in our 2024 outlook, we had argued that the first half of 24 was likely to resemble a soft landing in the US. And that, of course, in turn led us to suggest that investors should sail with the wind by being overweight equities. Now, thus far into 2024, this view appears to be playing out well. We can see that US growth data has been relatively resilient, with manufacturing registering an uptick. Labor market data has shown some weakness under the surface, but has thus far held up pretty well at a headline level. Inflation, of course, has been a little bit more persistent than we'd initially expected. Now, we would not interpret the benign data as the complete evaporation of hard landing risks. Indeed, the labor market is one example of macro data, which argues that we should remain on watch in case of any unexpected deterioration. Nevertheless, we are of the view that hard landing risks have reduced or at least been delayed. For the Fed, we believe this still argues for rate cuts, this starting this year in June, but the more persistent than expected inflation means that we now expect 3 rate cuts, totaling about 75 basis points this year, as opposed to our expectation of 5 previously at the time we published the outlook. So this, if anything, brings our Fed view in line with our ECB rate outlook, which for an FX market perspective, if you combine that view with the fact that FX market volatility seems to be unusually low, we'd argue this argues for an increasingly range-bound US dollar.
So it sounds like reduced risk of a hard landing. Does this keep you bullish on equities?
It does. When you think from an equity market perspective, relatively little seems to have changed since the start of 2024. We've got the improvement, of course, in the earnings outlook, which in our view makes up for a smaller than expected tailwind from lower Fed rates. We therefore remain overweight global equities relative to bonds and cash. This, of course, is partly driven by a preference for US markets. The nascent upturn in the manufacturing sector new orders is likely to support earnings growth amid still strong margins. In our view, these positives outweigh the risk from valuations and concentration, leaving us overweight US equities from a regional perspective. So that's one region. In Japan, of course, the Bank of Japan's policy tightening did prove to be less of a short-term headwind than was initially feared. So absent an imminent jump in the JPY, we believe this will allow markets to continue focusing on shareholder-friendly reform and rising share buybacks, both of which we believe can help sustain equity market gains. So we also remain overweight Japanese equities as a second major region. In Asia, of course, we're neutral Asia-Japan equities, but within that, a few interesting moving parts. So Chinese equities appear to be staging a short-term rebound, and many of you might recall our prior work on momentum, that's in last month's GMO, suggested that gains can extend further on a short-term basis at least once index gains cross 10% from the recent trough, as we seem to be in the cusp of. Having said that, greater policy support for growth is still likely needed for equity gains to sustain long-term in China. So therefore, from a 12-month basis, we leave a neutral view on Chinese equities unchanged. However, elsewhere in Asia, we have some upgrades. So we believe Indian equities have room to extend gains amid an extended US soft landing environment and likely policy continuity at the upcoming elections. Korea and Taiwan equities, meanwhile, should gain from the correlation with some of the US resilient economic growth data that we just discussed and a potential semiconductor sector upturn. So that leaves us overweight Korea, India, and Taiwan equities within our neutral allocation to Asia ex-Japan.
What about bonds? Does your updated Fed view create a headwind for bonds?
Well, say it reduces our return expectations slightly. So, directionally, our expected path of bond yields remains unchanged. So, we believe US bond yields are likely near a cyclical peak and have room to move lower as the Fed starts cutting rates in June. However, the move in yields is unlikely to be as significant as we'd anticipated at the start of the year when we also expected more Fed rate cuts. So, we're revising up our 12-month expectation for the 10-year government bond yield to a range of 3.75 to 4%, from what was a 325 to 350 at the start of the year. Now, for investors, this does not take away from a broader view that we would use the current opportunity to lock in what we see as still pretty attractive yields. It does mean that total returns may be somewhat lower than what we've previously expected, because that fall in yields or rise in bond prices is now more muted than at the start of the year. We now also, therefore, have a neutral allocation to fixed income as we see equity returns outpacing bond returns. Within bonds, of course, we also turn neutral developed market IG bonds based exactly on the same rationale that we discussed.
Thank you for the summary of our foundation allocation views. I think we discussed sufficiently about that. Let's move on to opportunistic allocation. Where do your conviction sits there?
Well, I'm glad you brought that up because, in the opportunistic side, this month we've introduced a new set of buy ideas, which represent the highest convictions on the absolute return side to populist the opportunistic allocations within overall portfolios. Now, within equities, we would buy the technology, communication services, and energy sectors in the US. The first two are likely to lead the performance of US equities should the rally extend as expected, but the energy sector is likely to benefit from increasingly shareholder friendly efforts of US oil producers against the backdrop of relatively stable oil prices. We would also buy India large cap equities, which we believe offer an attractive risk reward in an ongoing Indian equity rally. And finally, on the equity side, we'd buy Chinese non financials, high dividend state owned enterprises, for which we expect higher demand amid lower policy rates and yields. So that's a collection of buy ideas on the equity side. Over on the bond side, we would buy US inflation protected bonds, which we believe are still a little undervalued relative to how far inflation worries could go. We would also buy European government bonds on a currency hedge basis, given they offer exposure to what we see as downside growth risks in the region. And finally, we'd buy Indian rupee bonds, given their attractive yield relative to EM peers and ongoing support from flows from recent global bond index benchmark inclusion. So a collection of bond ideas on the opportunistic side, but of course not to be confused with the foundation allocations.
Thank you so much for bringing our listeners through the key highlights of quarter two outlook. If I could summarize them, it would be one, soft landing. That's good for equities. Hence, we stay overweight. We continue to stay overweight on equities. And two, bond returns expectations somewhat lower, but we still see attractive yield at headline level. And lastly, an interesting list of buy ideas, but as Manpreet has shared earlier on, we must be careful to separate foundation and opportunistic. If you'd like to have more details, you can find a copy of our reports on our Standard Chartered Wealth Insight page. And with that, let me sign off by wishing you a happy Good Friday holidays. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.